You can only pick one state in the United States to invest in. What is it?
Ooh, ooh. What, that's a hard one because oh
It's
my
not meant to
god,
be
because
easy.
I'm almost feel like when Biggie was singing that song about California, going back to Cali. And he's like, I live out
I
there,
want I
so
want
don't go
nothing to
there.
do with
So
California. You
yeah,
couldn't
I
pay me
mean,
to invest there.
no.
What's
I'm making an
going on
analogy
here?
between because Biggie is the East Coast guy, and he was talking about California, and he was saying how much he loves California. But in my case, is Florida. I live out there. We have deals there. We have
I love it.
a huge info. But I also love Texas. So I would, if I may, I have to say those two states.
Let's have some fun, gentlemen. Three guys at a bar. Let's making some friends.
Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan alongside my partner, the professor, Luigi Rosabianca. What's on tap today, Lou?
Matt, today we have a very special episode. We're going to be talking about bricks and mortar in North America. And today, to guide us through a state of the union of real estate in North America is August Biniaz. He is the founder and chief investment officer of CPI Capital, a real estate fund, as well as the host of the Real Estate Investing Demystified podcast. August, welcome to the podcast. Thank you so much for joining us.
Absolute, my pleasure, Luigi and Matt. Glad to be here.
August, we've been looking so forward to speaking with you because we hear so much in the news about housing crisis, poor startups. It's adversely affecting the economy. Rates are still high. Can you just start with a state of the union in real estate in North America, please?
Yeah, no, absolutely. I mean, today where we're at with interest rates compared to where we were just a few years ago, the cost of capital, the cost of the debt service is so high that, relatively speaking, it's made it difficult for a lot of people to either buy a new home or purchase their first home. It's just the cost of capital is high, relatively speaking. But everything didn't start here. I mean, we had this cataclysmic event that happened, a worldwide pandemic that resulted in the central banks having to print a lot of money, including the Fed in the U.S. and the central banks in Canada, for example, and resulted in people spending a lot of money, exuberance, which again resulted in inflation. And the central banks have really one lever to pull to battle inflation, and that's by increasing the Fed's funds rate in the U.S., the Bank of Canada rate in the case of Canada. And what that did, it actually brought a seismic type of effect to the real estate market when the interest rates are being increased by such a high velocity, going from 0 to 5.5%. It definitely creates some issues, both on the commercial real estate side, what I'm happy to get into, but also on the residential side, where the cost of a mortgage has gone up so high today. That's where we really are at. We also have a somewhat of a newer administration in the office. Trump historically has been known to be a real estate guy, a businessman, but some of his policies have been really headwinds for real estate. For example, I mean, a lot of the situations with immigration and ICE that really affect certain demographics within the housing. And when it comes to workforce, certain type of residents in some places, also tariffs are inflationary. So putting tariffs on a lot of close nations like Canada, a lot of lumber comes from Canada. So it's been a whirlwind of time, but that's where we're at today, I would say.
So where do you see, look, if we go back to the ZIRP era, zero interest rates, basically, right? People were borrowing, they were getting into commercial finance, commercial lending, but building a lot of building or buying multifamily properties, right? What I think most of our audience needs to understand is when you're doing a multi-family property, right, over 4 units or more, or commercial lending, it's not the same as residential lending. It doesn't go out 30 years. Most people are in 5, 7, maybe 10 years if they're lucky, right? So if you were buying a property back in 2020, we're now in 2025, your note's coming due. You need to refinance, right? Is that helping you right now because you're getting better deals in the market if you have cash, right? Because the numbers don't make sense and they're not penciling out for banks. And as of today, I mean, if it's all over CNBC, banks are getting caught out there with bad loans on their books. Now, does that mean that we're going to see more bad loans come about and more write-offs in these commercial properties?
Well, I mean, to answer your question, as far as is it advantageous for an investor today, it really depends where you are in your journey as an investor. If you bought deals in 2021, 2022, when cost of capital was low, and as you said, commercial loans have a shorter term than their residential counterpart. So it's a 3, 5, 7 year usually. The industry standard is usually 3 to 5 years. So it's a 3 year term plus one or a 5 year term, depending if you're getting from agency or other type of lenders out there. So yeah, a lot of groups that was got into the space. Debt was cheap, as Luigi talked about. Cap rates. Cap rates are really the cash on cash returns you get on a property if you're buying it for cash, not including your debt service. So if debt price is low, you're cash flowing day one and you're making a lot of yield on the property. So a lot of groups got commercial real estate investors really in different asset classes. Let's focus on multifamily and special. They got used to really putting variable rate type of debt, bridge debt on their loans. And they got used to that because from 2011 to 2019, the U.S. commercial real estate market and real estate market went on a bull run. The reason I say 2011 and not 2008 is because when GFC took place in 2008, it actually took a few years before liquidations and the bottom of the market. It was only till 2011 that the market started picking up again and prices started increasing and volume started increasing. So from 2011 to 2019, it was an absolute bull run. So a lot of syndicators, a lot of funds, a lot of institutions were putting floating debt, bridge debt on their deals to financially engineer the LP economics, the returns that investors get. As an investment firm, just quickly deviating and talking about this, as an investment firm, everything really spawns from the returns you're trying to achieve for your investors. If you're dealing with retail investors like a CPI Capital type of firm, you're looking to achieve around 15 to 20% average annualized returns for the term of the project, which is realized by both cash flow and the back end profits. If you're a larger institution like a REIT, you're trying to achieve something between 10 to 15%, in some cases even high single digits. But to be able to, that's where everything starts from. So when you do your analysis on a deal and you're taking factors in like your rent growth, like the cap rate, like the type of debt you're putting on, and so on, you always, the analysis really starts of what are the LP economics, what is the investor returns you're trying to achieve, and everything gets built back from there. So a lot of groups from 2011, 2019 got used to putting bridge debt, because by putting on bridge debt on loans, it actually pushes up those LP economics because the cost of debt is cheaper. You can get a higher loan to value ratio, which you don't have to raise as much LP equity. You don't have to raise as much capital. So then your investor returns increase. So when there was a bit of a pause when COVID came around, but then price of debt was dropped, the same group started putting back the same type of debt on their deals, which is not meant for these types of commercial loans. It's meant to get you from point A to point B. It's meant to get you from distress to stabilization. So when they did that, their term is usually 3 years. So the mortgage term expires after 3 years and they have to renegotiate. They don't have to reapply to get approved. They're already been approved, but they have to renegotiate the interest rate with their lender. And in most cases, lenders require you to buy an insurance policy, which is called a rate cap. So you can purchase a rate cap depending on where that strike point is at, to where your interest rates are at, or where you want that trigger point to be. So the closer it is to your current interest rate, the higher the price for those rate caps are. But when you're in a decreasing, in a loosening cycle of the market, those rate caps are very cheap. So a lot of groups were forced to buy rate caps. But when those loans came maturing in 2024 and now in 2025, they are forecasting around $500 billion of commercial loans maturing. Now, when they went to get their mortgage and renew their term, now they're paying, something that paid at maybe $50,000, $100,000 for the rate cap. They're paying close to $1 million, $1.5 million, sometimes $2 million for the rate cap, and their rates went from 4.5%, 5% all the way up to 8%, which completely erodes away any investor returns, and in some cases puts you below that 1.25 DSCR you want to be at.
Wow, that's amazing. I got another question for you. Can we just shift from residential to commercial? And this is just for me. Can you please explain to me how residential mortgages work in Canada? Because I know they work very differently than the States down here, and nobody's ever really been able to describe it for me. So I have you here taking advantage of it.
For sure. I mean, when Canadians, when they hear about, especially when mortgage rates were really low in the U.S. post COVID, when you could get I have a neighbor of mine in Florida, in Naples. He locked in his mortgage rate at below 1%. So
Hmm.
that's shocking, right? I mean, that doesn't always happen. He's in the mortgage industry himself, but there is a lot of cases. I think currently residential mortgages in the U.S. sub 4% or around close to 50% of mortgages are sub
Yeah, a lot of
4%,
them.
some insane high number. So if you can fix a mortgage at, in some cases, at 2%, 2.5%, 3%, inflation is at 2.5% in a healthy economy. So if you're locking in your mortgage at 2.5%, 3%, you're pretty much getting paid to borrow money.
Yeah,
It's absolutely insane. And to have that locked in for 30 years where you're completely have a peace of mind that you have this low mortgage rate, and is in my opinion is a lottery ticket. Now in Canada, it's not the same case. Our term is shorter, so you get a 5-year term in most cases from for it to be a really competitive type of rate. Your standard rate is it's got to be a 5-year term. So after 5 years, you're going back and you are renegotiating your rate with your lender. So that's a big difference really between Canada and the U.S. Another part is also stress test. So at GFC, when the subprime mortgage crisis resulted in the U.S. economy coming to massive recession, and that's what the name is on it, right? Great financial crisis, was because those mortgage tests weren't there, so they would lend money pretty much to anyone. Some jokes lenders have that if you could breathe, you get it. It is a funny thing. If you could move, you could get a mortgage for a place. In Canada, those the stress tests are more restrictive, so it's harder to get approved for a mortgage. So the term is one aspect of it. Another aspect is getting approved for a mortgage.
yeah. But don't you have to refinance them? What is the actual term that they usually go out in Canada?
Refinance.
Yeah,
I
don't you
mean,
constantly need to be refinancing the mortgage in Canada?
yeah, when the
Yeah,
term expires in 5 years, you have to
in
renew your
5 years.
mortgage.
It's
You
every
have to
5 years. Okay.
every 5 years. Yeah, I mean it depends. If you get 10, no, you're paying a higher rate because it's fixed for 10 years. You're paying a higher rate, or if it's floating, you're paying a higher rate if the term is longer.
Appreciate that. And what do you got working? What are you working on now? What are you guys working on over at CPI?
CPI, yeah, no, absolutely. I mean, we just entered the Texas market. I mean, San Antonio in particular. We have another asset in Texas, in Houston, but we entered the Texas San Antonio market in Texas for a build to rent project. And happy to kind of give a quick crash course on what build to rent is.
Please.
Really interesting asset class under the commercial real estate umbrella. So under the commercial real estate umbrella, you have these different asset classes. You have multifamily, you have industrial, hospitality, office, and so on, retail. So build to rent is an offshoot or branch of multifamily. And the story is somewhat of a newer asset class. So post GFC, when there was a housing crash across the U.S., single family residential home prices dropped by 30%, and nationwide, in average, they dropped by 30% in value. And Wall Street, a lot of large investment firms in Wall Street, particularly in this story, Blackstone, which is one of the largest private equity firms in the world, I believe they are the largest one today. They had this idea of they knew the market was going to turn around. Their thesis was that real estate prices in the U.S. had gone up on the single family side had gone up every single year from 1948 till 2008. So they knew that the market was going to come back. And their business model was, how are they going to be able to go out there and buy as many single family homes as possible? So that was their strategy. And they started buying homes. They ended up buying 50,000 single family homes scattered. These are scattered sites. They bought 50,000 single family homes. They started a company called Invitation Homes. They took that company public. They ended up buying around 85,000 homes by the time that they exited those homes. And this was Blackstone. They partnered with another group to do that business model. But that was kind of a spawn of a new asset class that institutions could actually purchase lots of single family homes. By mid teens of by 2014, 15, they could no longer buy homes on pennies on the dollar. But that business model still made sense. So what they started to do, they actually started partnering with developers and building communities of purpose-built rentals, which was kind of really the start of build to rent. The epicenter of it was in Phoenix. So I started building these communities that had amenities, but it was single family home. So something it was a safety of having a garage, nobody living above you, next to you, and it served a certain demographic. It really served the demographic of renters by choice, not renters by necessity. And the asset class has grown since then. So that's the type of deal that we got involved with in San Antonio. So we partnered with a local developer in San Antonio. We bought a piece of land. We've taken it through entitlement, and we're building 30 duplexes, 60 units. The business model is a bit different than your classic build to rent. Classic build to rent, you buy a piece of land, you stabilize, you go through the entitlement price process, you build a community of single family homes, and then you get it to stabilization and you sell to an institution. In our case, we have de-risked the project a bit by pre-selling these duplexes to investors who are looking for cash flow. These are mostly California type of investors who come to Texas. They want to make cash flow on these duplexes they're purchasing. So we're building them. Our developer partner also has a property management arm. So they're vertically integrated. So they're managing these properties on behalf of these investors that are buying these duplexes. And they're cash flowing day one. Now our investors, CPI's investors, come in and they fund the equity that's needed to do the development part of the project. So it's a quick turnaround, 1.5 to 2 years. But yeah. That's quickly about
awesome.
that.
And then, like in the San Antonio market with these duplexes, what are they? Are they 2-2s? Are they 3-2s?
They are three. They're 3-2s.
And what type of what does the pricing out there look like, and what type of rents are you expecting in the future?
Our pro forma, as far as the price, is $625 for both sides of the duplex for 2 units. And the rents, now we have done something called a rate buy down through our lender, our preferred lender for our investors, which it actually creates that buffer for them to be cash flowing. But as far as the rents, we are forecasting around $1,800 a month rent on a per unit basis.
Nice.
So you help the investor find that Goldilocks zone where they're cash flow positive that allows them to pay their principal and interest. It's a great model.
Exactly, and make around $1,000 a month in cash flow while they're building equity in these projects.
And then you guys exit when the community is sold out, right?
We exit as soon as the communities are sold. Now they're pre-sold, so by the time their certificate of occupancy comes around and the investors get their keys, the owners get their keys, we have exited basically in tranches as they're being sold.
Nice.
And given what's going on with macroeconomic conditions in a lot of these larger urban centers with higher property taxes and fiscal impropriety, and then also with insurance rates increasing through either acts of God or climate change, seems like San Antonio also offers you that Goldilocks zone where your costs are somewhat modified.
Exactly. Yeah. San Antonio, I mean, historically has been somewhat of a workforce demographic. It's still a city of 3 million people. So it's, usually when you think about Texas, you're thinking about Houston, Austin, and Dallas, Fort Worth. But San Antonio is an hour and 15 minutes away from Austin. So it's got a lot of spillover. There's huge amounts of public-private infrastructure going in. As we drove around San Antonio, we could see all these elevated highways being built. So when you're seeing that much infrastructure going in, you know that the municipality and the government is seeing the growth that we might not, our data might not support. We do support certain data, but not as much as the development we've seen there. The issue that is another anecdotal, somewhat of a fun take here that we can discuss is that in the U.S., because there's so much development that you have, as a commercial real estate investors, one of our concerns is hypersupply, oversupply, as it's known. So too much being built. In Canada, it's the second largest landmass country in the world. It's got a lot of land, but you never have that problem of hypersupply because it just, with a government bureaucracy and a lot of different reasoning, the yields are just not there. So you don't have hypersupply. You're always in this deficit
August,
for
welcome
housing.
to America. We don't have any bureaucracy. Smooth sail.
No, but believe me, when you look at like cities like San Antonio, the process of entitlement, I mean, it took us 4 months to go through the process of entitlement for our
That's wonderful.
Apollo Oaks deal in the Helotes market. The same similar project, a 20-unit townhouse project that I built in Vancouver years ago. It took us 3 years to go through the entitlement. So imagine
Oh,
the
wow.
cost of capital when you have to hold the property that long
It's
while you're
huge.
going through the entitlement process, especially land values as well. So yeah.
August, believe it or not, it's Q4 already. The whole year has flown by. And a lot of the small business owners that are listening today have to do some tax planning. So when you are talking to your investors at CPI, is the pitch a return on investment? Is it depreciation, or is it both?
Yeah, I mean that's an aspect that we utilize for our U.S. investors. Now, unfortunately, our Canadian investors don't get to utilize depreciation at the same velocity as our U.S. investors get to do. Now, with the big beautiful bill, the depreciation is coming back to 100%. I'm not sure where that it is in his timing currently, but as you know, in the Biden administration, the depreciation was being precipitously dropped
Yeah, no,
down.
it's
But
effective this
now,
fiscal year.
yeah, so yeah, that's definitely an aspect of it. Also, the gains are capital gains; they're being taxed at capital gains rate, not as at ordinary income rate. So that's another benefit for investors. And yeah, investors can also use their retirement accounts to make an investment in a syndication. So that's another aspect that's at times investors, they're unaware that they could use their retirement accounts, or as in Canada, they're known as registered funds, to be able to invest in syndicated deals.
Matt, do you have your credit card with you? Let's make a deal right here.
Let's do it. So let me ask you this. When you guys decide to go in and work with, like you said, you partnered up with a developer in Houston, right? How do you guys decide to do debt, equity, or a JV with people?
Yeah, so I mean, our deals, when it comes to syndicating our deals, our investors who come in, they're coming in as equity, so they're
Hmm.
participating in the upside, and so we're not offering any type of debt instrument when it comes to our investors. The debt comes from an institution that we're borrowing funds from. Now, on the multifamily value add side, comparing to build to rent, or any development, there is more risk associated with development. So the type of lender and the type of loan that you're borrowing is different on the development side than it is on multifamily value add, or any value add deal really. So that's another aspect to think about. As far as our development partner, they've been in the San Antonio area building projects for the last 25 years, quarter century. So myself, our executive team, and our development partner jointly signed on the loan. So we're guaranteeing the loan, and we're sheltering our investors from having any exposure to any type of loan guaranteeing or any concerns there. So the general partner has unlimited liability, and the limited partner has a limited liability in our structure. I hope that answered the question, but happy to
Yeah.
expand more.
No, that's perfect. I love it. Listen, I've done a ton of deals, right? Good deals, bad deals, some deals I wish I'd never heard of before, right? One thing that comes down to me is the operator and who's running the company. And Luigi will tell this, even in deals that we do together. There's one thing that even if a deal goes bad, as long as it's there, it means the world, right? And that's communication, communicating with your investors. And I feel a lot of GPs don't do a good job of that. Something's going wrong. As we know, when there's no news, at least say something. Tell us what's going on again. Because when radio silence hit, bad thoughts start to seep in people's heads, right? So how do you guys go about communing with your investors on a regular basis?
Yeah, a lot of great points there. So I'll try to demystify a few of those there. But particularly when it comes to investor reporting, as we call it here at CPI, we felt that it is very difficult to compete with other larger firms who've been in the space for a long time. We're talking about REITs, publicly traded REITs, large investment firms. Groups have done billions and billions of dollars in transactions. So when a group like us comes in, it's very hard to compete because yes, we're serving to a certain demographic, but how are we going to be able to compete with large firms as such that I just mentioned? And reporting is one of those ways. So our reporting is very robust, not only on the property level as far as what's happening with the property. We provide monthly reporting on what's going on with the property, pictures about before and after, what's happening with the market, what's happening with that. With our occupancy, vacancy. We also provide quarterly financials, so they can see more about where, as far as type of profits, losses that property has made. So that's one way to be competitive with larger firms that don't provide as much reporting as we do. The other part is we host educational webinars for our investor community, provide them a lot of information, all these free webinars. We're not in the coaching business in any way, and we're never planning to get into that business. We want to be hyper-focused on what it is that we do. So we notice sometimes other firms have a coaching business on the side, so that's not a business we're in. But we still create a lot of content and information for our investors. We provide we send a weekly email every Sunday at 6 a.m. Pacific time, 3 a.m. Eastern time, about an update about the market, what's going on, a preview of our most recent podcast that we've held, a snippet of all the macroeconomic factors that are affecting real estate. So every Sunday they're receiving that in their inbox. Now, this is for our current investors and potential investors who are sitting in our database thinking about investing with us. So that's as far as kind of reporting and communications with investors. We have an investor portal where they can log in and have a look at how their deal is doing, and so on. And the executive team is you're not like, it's not like a REIT or a large fund or an investment firm where you're just another number. They can have direct contact with the executive team, myself, the CEO, or the VP of investments, Paul Hopkins, our CEO, Eva Benasaki. So the executive team is there very much at reach. So it's not a case, and they have our personal numbers. A lot of times we're friends with a lot of our investors. Another point I wanted to cover that I think is super important is the concept of, is it more important the jockey or the horse? And a lot of times in investment deals, you always want to focus on the jockey. I have to stress that that's not always the case. It is usually the case as long as you have the right operator, the right sponsor, the right GP. The deal should go fine. And if things go the wrong way, we have an expression in Persian that what an older person can see in clay, a young person can't even see in a mirror, right? And I mean, in Farsi, it sounds a lot better than that. So you want to see somebody who's seasoned, but keep in mind when there are situations. Now, there's another similar firm to ours. They're much larger than us. They've done billions of over $5 billion of transactions. But when post-COVID era came in and rates started increasing, a lot of their deals went upside down, and they have lost over $300 million in LP equity, $300 million. And wow. One of the reasons there is, and I'm not just saying that was unscrupulous or it was incompetence, but a lot of times these larger firms have a lot of employees that was very difficult to source those employees, to also retain those employees. That talent, retaining talent, is very difficult. But so when things slow down, they have a hard time letting go of that talent. So they have to do deals to get those fees coming in to keep the lights on. With CPI, we sat on the sideline from 2022 for 26 months, not doing deals and burning through cash because we were a nimble team. So in most cases, you're 100% right. It is the jockey, but in some cases, the jockey can be a better jockey, but might not do as good of a job. So,
Matt, I don't know about you, but I want to hear that saying in Farsi.
Oh gosh, my mom has said it 1,000 times to me, but I'm not sure if I can. Yeah, I'm not sure if I can memorize. I don't want to.
Next time we have you on, it's on you to have it ready.
Sounds good. Or maybe when I have one of you guys on our podcast, I will.
Yeah, let's definitely do it
for sure.
August, thank you so much for being here. We want to be respectful of your time. Can you tell the audience where they can find CPI?
Of course, CPI, www.cpicapital.com. I'm very active personally on LinkedIn. I'm a LinkedIn top voice, not to brag about it or anything, but it's invitation only to be a LinkedIn top voice. So I'm very active on LinkedIn. Connect with me. Tell me you see me on the podcast, you see me on the show, and I'm happy to give you some time and answer any questions that you may have. August Biniaz on LinkedIn.
I love it. August, thank you so much. One question before I let you run. You can only pick one state in the United States to invest in. What is it?
Ooh. Well, that's a hard one because my goodness. I'm almost feel like when Biggie was singing that song about California, going back to Cali, and he's like, I live out there.
I want nothing to do with California. You couldn't pay me to invest there.
No, I'm making an analogy because Biggie is the East Coast guy, and he was talking about California, and he was saying how much he loves California. But in my case, is Florida. I live out there. We have deals there. We have a huge info. But I also love Texas. So if I may, I have to say those two states. I mean, you can't go wrong with it. They both
Yeah, I
have
think
more than 400,000 people moving to those states this year alone. I mean, I'll tell you one more thing. Texas and Florida individually have a larger economy than the whole country of Canada. Florida has more airports than the country of Canada does.
that's crazy. I
Yeah.
never thought
So,
about
I
it
mean,
like that.
it's just mind
Matt, are
blowing.
you happy? You asked for a question, and instead of Farsi, you got hip hop.
Oh, well, listen, I just found out that, and I'm going to start using that. Florida has more airports than Canada. Did you know?
That might be. I'm not sure if that's international airports or just airports in general. But that's just got to look into that before state.
I'll tell them to fact check me. Doesn't matter.
Yeah.
August, thank you so much. Everybody, that's a
Thank
wrap.
you.
The Liquid Lunch Project. We'll catch you on the next episode.